This is the second video on the topic of weighted average cost of capital for BU 655. In this video, we're going to continue on calculating the weighted average cost of capital for Caterpillar, and then we're going to look at how we can calculate a divisional cost of capital for a firm. So where we ended in the last video was on the topic of calculating the cost of equity for a firm. And we were looking at Caterpillar here. And for Caterpillar, we came up with four different estimates. The discounted cash flow estimate for using historic dividend growth as the growth rate was 10.45%. The discounted cash flow estimate using analyst estimate for growth was 15.20%. The discounted cash flow method using ROE times the retention growth rate was 38.24%. And then finally, the capital asset pricing model provided an estimate of 8.9%. So this is kind of the point where we have all these estimates and we have to make a decision. Do we want to use one of these estimates, or I've got an option down here for other. We might have a different number in mind when we think about the company. So this is where you need to think a little bit about what you're using the weighted average cost of capital for and this cost of equity for, and what it is. So the cost of equity is the required rate of return that the stockholders have for this company. On average, the S&P 500 provides a return of between usually 10 and 11% per year, and that's the average. It actually varies quite a bit from year to year, but over several years' time, if we took the average, it's generally in that 10 to 11% range. So that's a good place to kind of start when you think about a company. How does it compare to the average company out there? So we can get an idea from the beta of the firm, which is the firm's returns sensitivity to market or macroeconomic risk. Caterpillar has a little bit higher than average beta, 1.12. We can kind of, dismiss at least one of these cost of equity estimates because it's really kind of out of the range of what we would expect for a company like Caterpillar, and that one would be the discounted cash flow ROE times retention rate. So this estimate here is kind of arbitrarily high, and the reason why is because over the last several years Caterpillar has been repurchasing its stock, and so the effect that that's going to have is that it's going to push up that ROE. If you remember from the modified DuPont analysis, an increase in the equity multiplier, in other words the percentage of the assets that are financed with debt, as that goes up, the ROE increases. And so they've been pushing up their ROE by taking out more and more debt every year and then using that debt to repurchase shares of stock. So that's had a big impact on the capitalization of the company and the capital structure. And so that's why this one is very high. And you'll actually see a lot of companies right now that have high ROEs because they've been doing that. And they did that over the past several years, about the past 14 years, because interest rates have been so low that it made sense for them to go out and take out long-term cheap debt and use that debt to repurchase shares of stock. As interest rates have been climbing, that's going to make less and less sense for companies to do. So we're gonna knock this one out just because it's really out of the range of what we would expect for a company like Caterpillar. Okay? And the reason being is that they've recapitalized their company. So later on in the course, when we talk about capital structure, we're going to revisit this idea, and we'll talk about that a little bit more. So then we've got three other estimates here. And I'm going to take a break and go to your notes and explain why it's important to select the right cost of capital. So I'm just going to put in your notes here before determining the weights of the capital components. It's important to remember that the goal of selecting a cost of equity is to select the estimate that is closest to the actual cost of equity for the firm. We're going to get into capital budgeting, and that's where we use the weighted average cost of capital again as the hurdle rate for the projects of the company. And so if we select a cost of equity that's too high, we're going to reject good projects. Because if our cost of equity is too high, if the ones we're choosing is too high, if it's higher than the actual cost of equity, then we're going to be we're going to say no to projects that would actually add value to the company. Okay. The opposite, the counter to that is that selecting a cost of equity that is too low will result in the acceptance of bad projects. In other words, projects that aren't going to actually earn a high enough required rate of return for our investors. And what the effect of that, if we're accepting projects that don't actually go over that hurdle, the actual rate of required rate of return, that means that we're going to be accepting projects that will destroy value. It'll decrease the value of the company. So the goal isn't to select the highest value. It's not to select the lowest value. It's really not to select the middle value. It's to select the value that is best represents the required rate of return that investors would have for that company. Okay. So going back to our estimates out here, we have these four, and I want to make one last note here. Something I see a lot of people do whenever they're faced with all these options is to select the average. Just take them all, put them together, and get the average. That's the wrong thing to do. In this case, because we have an outlier here, if we took the average of these, the average would probably be too high. Okay. So please don't take the average return or required rate of return. Select the one that you think best, and you can kind of justify as best representing the required rate of return for that stock. So for me, if I were to just look at these four and had to select one, I would probably select the analyst estimates for growth option here. And the reason being is that the company has some risks, and we're going to see this when we look at the balance sheet here in a minute. But the company has some risk with financing. So Caterpillar Finance has a finance division, and that finance division is used to finance the sale of their big pieces of equipment to their buyers. Well, right now we're in an increasing interest rate environment, and so what tends to happen with this type of product in an increasing interest rate environment is that the demand for it goes down, because as the cost to borrow increases, the demand, the people willing to finance those purchases will decrease. And that risk is compounded for Caterpillar because they act as a financing company in addition to a manufacturer of equipment. So I'm going to say their risk is a little bit higher than the average firm in this case, and especially even taking into account the beta here of 1.12 going forward. I think this is probably going to increase. We're coming out of a period of low interest rates where that really wouldn't have affected Caterpillar negatively, but now as interest rates are going up, they're probably going to become a little bit more sensitive to market risk and macroeconomic risk. So that's why I'm choosing this 15.2%. What I would look for you is just a justification as to why you're choosing the cost of equity that you are whenever you go to calculate the weighted average cost of capital for a firm. Okay, so that kind of takes us through the cost of equity portion. Now we're going to look at the weights of the capital components, and if the firm had preferred stock, we would include it here. Caterpillar doesn't have any preferred stock, so we're just looking at the market value of the firm's. This is the common equity for the firm. We're also going to take into account the value of the interest-bearing debt, and that's going to give us the total market value of capital for the firm. So the market value of the firm's equity, we're going to take that from the tear sheet, and this is also known as the market capitalization. I'll just make a note out here. And what this value is, it's the number of shares outstanding multiplied by the price per share. So it's the total value of the stock in the marketplace for the firm. So going back out to the tear sheet, we're going to look at the market cap here. It's 154,379.9. The value of the interest-bearing debt for the firm, we're going to go out to the balance sheet for this. So what I'm going to do here is I'm just going to select equals. I'm going to go to the balance sheet, and I'm going to go to the most recent time period. So remember, the balance sheet is a point in time, and so the most recent point in time we have for Caterpillar is September 30th, 2023. So this is about 3, 4, yeah, a little over 4 months old, so it's pretty recent. We're going to take a look at here, and what we're interested in is the interest-bearing debt, not all the liabilities of the firm. So the interest-bearing debt, I'm looking at here, short-term borrowings. There are none. Current portion of long-term debt. There's about $1 billion worth of the current portion of long-term debt, and this is just the portion of their long-term debt that is coming due in the next 12 months. Finance division debt. So this is debt their finance division is taken out, and what they're doing is they're borrowing money to lend that money out to their customers, and that's $11.8 billion worth, so quite a bit there. And then we're going to add to that. Now that's the current interest-bearing debt that they have. Now we're going to look at their long-term debt. Their long-term debt consists of $8.47 billion in long-term debt, and the finance division debt, a non-current, is $15.789 billion. And that's all the interest-bearing liabilities that they have. The other liabilities are not interest-bearing. They're not a form of financing for the firm. You see things on here like unearned revenue. That's going to be a situation where, you know, they're probably building equipment for someone. The money has come in from the customer. However, you know, they have not delivered the product yet, and so that will oftentimes be categorized as unearned income. So we have the interest-bearing debt for the firm, and that is $37,139,000,000 worth. And so now we're going to add up the market value of the firm's equity plus the value of the interest-bearing debt to get the total market value of the capital. And capital in this case are the investor-supplied funds. So we have, you know, investors as the stockholders, and that is the market capitalization or the market value of the firm's equity. And then we have investors in the form of bondholders and or other lenders that are supplying debt to the firm, and that is $37.139 billion worth of debt there. So our total market value of capital is $191,518.9. The weight of equity is going to be equal to the market value of the firm's equity divided by that total market value of capital. So it's 80.61%. And then the weight of debt is equal to 37,139 divided by 190,1518. Note that the sum of these two numbers is 100%. So that's what you need to get whenever you calculate these. So now we have our weight of equity and our weight of debt. And I'm going to go back over to the notes now. So what I have down here is just what I've shown you here. The value of the total capital of the firm consists of the market values of the claims of investors against the assets of the firm. To determine the market values of common and preferred equity, the market capitalization is used. And like I said, for most firms, we're not going to have preferred equity. If we do, we would just add that in as another line in that total capital calculation. The book value of interest-bearing debt is usually a good proxy for the market value of debt unless the interest rate on debt deviates significantly from the current yield to maturity on the firm's debt. And if that's the case, then the value of that debt on the books is not going to be accurate. But if the interest rate that the company's paying on that debt is consistent with the current yield to maturity on the debt, then the value on the books is going to be pretty accurate. So the total capital is equal to the market value of common equity plus the market value of preferred equity plus the book value of short-term debt plus the book value of long-term debt. And remember, for the debt, it's just the interest-bearing debt. It's not the other forms of liabilities that the firm has. So what we did on the spreadsheet was to take the value of the capital component divided by the total capital to get the weight of the capital component in the capital structure. The weights for the weighted average cost of capital can also be estimated based on the target capital structure for the firm. So now I'm going to go back to the spreadsheet. I'm scrolling up here to take you all the way back to that weighted average cost of capital equation, because now we're going to apply that equation right here to calculating the weighted average cost of capital for Caterpillar. So the equation says that the weighted average cost of capital is equal to the weight of debt multiplied by the cost of debt, and note that this is the yield on the firm's 10-year bonds, multiplied by 1 minus the tax rate. And again, we do that, we take out we multiply by 1 minus the tax rate because the interest for a firm is tax deductible. So there is a tax benefit to that debt. And then we have the weight of equity multiplied by our estimate for the cost of equity that we chose. In my case, I chose 15.2% for Caterpillar. And that would give us a weighted average cost of capital estimate of 12.93%. Now, we would use this for two different things. One, as the company goes forward, the hurdle rate for its projects that it's going to look at would be this 12.93%. If we're valuing the company, and again, later on in the course we're going to do this, we would actually discount the free cash flows for the firm back to today by this 12.93% to determine what the value of the company is today. But again, we'll take a look at that later. Okay. So now I'm going to go back out to the notes, and we're going to talk a little bit about how to adjust the cost of equity for a change in capital structure. And then we're going to take that and we're going to use that idea to to determine what the cost of equity is for just a segment of the firm. Okay. So, adjusting the weighted average cost of capital for a changing capital structure. If a firm increases the proportion of debt in the capital structure, the cost of debt is expected to increase due to an increased cost of bankruptcy. But what happens to the cost of equity? Well, the cost of equity should also increase. due to the increased risk of bankruptcy. Because if the company goes bankrupt, well, then the stockholders often don't get anything. So an increased cost of bankruptcy can result in an increase in the likelihood of a loss for the stockholders. And so we want to show that in the cost of equity, or the required rate of return for equity. There are two definitions of beta: the asset beta and the equity beta. The asset beta is a measure of the market risk of the firm's assets without taking into account the capital structure of the firm. It is also referred to as the unlevered beta. The equity beta is a measure of the market risk of the firm's equity, which takes into account the capital structure of the firm. It's also referred to as the levered beta. When we look up beta for a company, what we're seeing is the levered beta. Okay, we can unlever it though to take out the effect of the capital structure of the firm. The beta provided on financial websites and calculated using the returns for the firm's stock and the returns is the equity beta, or the levered beta. The Hamada equation is used to estimate the effect of a change in capital structure on the beta and the cost of equity. This is what the Hamada equation looks like, where B is the levered beta, so B is the levered or the equity beta, and B sub U is the unlevered beta or the asset beta. Sorry about that. There we go. And I think I may have said equity beta. I meant to say asset beta. Okay. So what this equation says is that the beta for the firm, the levered beta, is equal to the unlevered beta multiplied by 1 plus 1 minus T is the tax rate, and the weight of debt divided by weight of equity. To calculate the asset beta, so unlevering the beta, we take the regular beta for the firm, the equity beta, divided by 1 plus 1 minus the tax rate, multiplied by the weight of debt divided by the weight of equity. For the weight of debt and the weight of equity, we can actually also just use the values of debt and the market value of equity, and we'll get the same relationship, the same value for that ratio whenever we do that. So we're going to actually work through a couple of examples of this. So I'm just going to start here with an example of unlevering a beta. So we're going to say that the beta for the firm, so the equity beta, is 1.5. The tax rate is 20%. The value of debt, and this is going to be the interest-bearing debt for the firm, is, we'll say, 20,000, and the market value of equity, or that market capitalization, is 100,000. Actually, I'll use a different number there. Is 60,000. So our equation here So my B is 1.5, my tax rate is 0.2, or 20%. And like I said, I can use the actual values here. We could add these up and we could calculate the weight of debt and the weight of equity, but we'll actually get the same outcome if we just put the values in. I'm going to put in 20,000 divided by 60,000. And I'm going to go back to my spreadsheet to calculate this. So I'm going to take equals 1.5, my numerator there, divided by, and then in parentheses I'm going to put in 1 plus, and then open parentheses again, 1 minus my tax rate of 0.2 multiplied by my weight of debt divided by weight of equity, or the value of debt divided by the value of equity, 20,000 divided by 60,000, and then close parentheses again. And it's important to have those parentheses in the right place. You're going to get a very different answer. Now, before I press enter, one thing to note is that since we have debt in our capital structure, the unlevered beta should be less than the levered beta, or the asset beta should be less than the equity beta. Okay, so I get a value here of 1.1842, but we'll just round that to 1.18. And I want you to note that that is less than the equity beta. Okay? And then the reason for this is because we have debt in our capital structure, that debt increases the sensitivity of the firm's returns to a change in interest rates or a market risk like that. And so we would expect the equity beta to be greater than the unlevered or the asset beta, which is what we have here. Okay. So that's an example of taking an equity beta and unlevering it to get the asset beta. Now we're going to do the opposite. We're going to actually take this beta here and we're going to say that the firm's changing its capital structure. So it's increasing the amount of its debt to 40,000, and it's going to take that additional 20,000 of debt and repurchase $20,000 in stock. So it's going to reduce the market value of its equity to 40,000. So that's actually going to give us that weight of debt to weight of equity. This value here is going from 1/3, 2 divided by 6, to 40,000 divided by 40,000, or 1. So a fairly large increase in that ratio. Okay, so now we're going to go back up here to lever our beta. So my unlevered beta was 1.18. My tax rate stays the same as 20%. And then my weight of debt divided by weight of equity, and again I can just fill in the numbers here. 40,000 divided by 40,000. This number is just going to be 1. So it's 40,000 divided by 40,000. But when I go to calculate it, I'm just going to put a 1 in there because that's what it is. Okay. So to break down this number a little bit for you, we have 1 plus 1 minus 0.2. So 1 minus 0.2 is 0.8. Multiplied by 1 is just 0.8. So this number in the bracket is going to be 1.8. So we're multiplying 1.18 by 1.8. And I'll go back out to the spreadsheet. just to show you how that's done. So here's my unlevered beta of 1.1842. So now what I'm going to do is I'm going to take and say this is equal to 1.18 multiplied by 1 plus, and then in parentheses 1 minus 0.2 multiplied by, and you can put 40,000 divided by 40,000. I'm just going to put 1 in here because that's what it is, and then close parentheses to get a value of 2.124. And so that is our new levered beta. And what we've done here is we took the original beta for the firm, we unlevered it, and then we relevered it using a different debt to equity ratio, or different values for debt and equity there. And what you can see here is as we add debt to the firm's capital structure and increase that ratio, that increases the beta, and the overall effect then would be to increase the cost of equity for the firm, because we would use that beta then in the capital asset pricing model with the security market line to determine a new cost of equity for the company after they relever it. And we're going to use that here in a minute to determine the divisional cost of capital for a firm. So when we have companies out there that have more than one business segment that they operate in, and it would be inappropriate to use the same weighted average cost of capital across very different business segments. I'm going to give you an example here of a company that I've several years ago had the opportunity to go and talk to their CFO, a publicly traded firm up in Wisconsin, and kind of give you, tell you a little bit about that company and how they looked at their cost of capital. So the company we're going to look at is the Marcus Corporation. And the Marcus Corporation is a little bit different because it operates in two very distinct segments. It operates in the movie theater, and in those movie theaters they also have restaurants and things like that. And separately, they also operate a lot of different hotels in the United States. So when I had the opportunity to go up and meet with the CFO of this corporation, they stated that the way that they evaluate projects differs between the two divisions that they have, because they're two very different companies and they respond to market shocks or macroeconomic risks very differently. So for example, the hotels, because the hotels that they have generally cater to business customers, that the revenues and the earnings for those hotels are actually very sensitive to the economy and what's going on in the economy, because if we're in a recession or where the economy is contracting, businesses tend to pull back a lot on travel for their employees during those times. So the hotels are actually hurt quite a bit whenever the economy is doing poorly, but tend to do really well when the economy is not doing poorly, when things are going really well. On the other hand, the theaters that they have, this was whenever I met with them up there, this was long before COVID. So we're not talking about the effects of COVID here, we're just talking about the effects of the economy in general. The theaters actually aren't hurt much at all whenever the economy is not doing well, because for a lot of people, going to the movie theater is a splurge, and it's something you do if you have extra money. But for other people, it's a substitute good. So when times are really good, they're going to go on bigger vacations, or they're going to go to concerts that are more expensive. But when times aren't so good, they're going to use those entertainment dollars that they have to go to movies instead. And so what they said was, whenever the economy's not doing well, our movie theaters still do great. And so we have to take a look at projects between the two different segments, having different risk. And so that's what we're going to do here. What we're going to do is calculate the cost of equity using the capital asset pricing model, and using a technique called a pure play. So what I've got here is two different companies that are very similar to the segments, or should be somewhat similar to the segments of Marcus. So here I've got Marcus Corporation. The most recent year, their theater revenue was $407 million, and their lodging revenue, $407.7 million, and their lodging revenue was $235.7 million. And so we see here that they're two very distinct companies. And we're going to calculate the differences here between them using what's referred to as a pure play. So the pure play for the theater segment of Marcus Corporation is Cinemark Holdings, and Cinemark Holdings is a company that owns a lot of movie theaters. Okay. The Marriott, which you're probably familiar with, owns a lot of hotels, and so we're going to use Marriott as the pure play for the lodging division of Marcus Corporation. So the first thing we're going to do is calculate the asset beta. Now, I mentioned that the theaters weren't very sensitive to market fluctuations. However, you'll notice here that the equity beta for Cinemark's quite high, and that's because Cinemark uses a lot of debt in their capital structure. So the market value of Cinemark isn't very high relative to the amount of debt they have. So when we unlever this beta, the asset beta is going to be a lot lower, because what's pushing this equity beta up is this high weight of debt to weight of equity value that we have here. So I'm going to use that Hamada equation and unlever the beta now. So here I'm going to take equals, and we start with the equity beta, and we're going to divide that by, and again, the parentheses are important here where you put those in, 1 plus, and then open parentheses, 1 minus the tax rate for Cinemark Holdings, multiplied by the weight of debt divided by the weight of equity, or 1.83, and then close parentheses there. And we get an asset beta of 0.90. So you see the beta came down quite a bit because we unlevered it. Again, the reason why that beta is so high for Cinemark is because they have a lot of debt. Now we're over here looking at Marriott. The beta is not going to decrease by as much because they don't have a whole lot of debt compared to the market value of their equity. So I'm just going to take this here and take this as the asset beta is equal to the equity beta. Again, it's the same equation we just did for Cinemark, divided by, open parentheses, 1 plus, and then open parentheses again, 1 minus the tax rate, multiplied by that weight of debt divided by the weight of equity, and we get a value there of 1.38. So notice again that the asset beta is less than the equity beta. So when you calculate this, that's what you should find. If the company has debt and if it has a positive tax rate, then that, well, actually it doesn't matter if it has a positive tax rate, but the asset beta should be less than the equity beta. So now we're going to go over to Marcus, and we're going to relever these two pure play betas for their theater and for their lodging. Okay. So I'm going to put it equals, and the asset beta for Cinemark. So again, what we're doing is we're relevering these. So instead of dividing, I'm multiplying, multiplied by 1 plus, and then open parentheses again, 1 minus the tax rate. So if you looked up the tax rate for Marcus, it's been weird. It's actually, for the most recent time period, it's actually showing up on Capital IQ as almost 60%, but they also had 3 years of not paying taxes, so it's kind of weird. I estimated about a 40% tax rate, so the kind of the highest marginal tax rate that they can have. And again, that's because of kind of some weirdness that they had, but we could adjust this as well if we needed to. 1 minus the tax rate multiplied by that weight of debt divided by weight of equity. Oh, sorry, need to close parentheses, and then multiplied by the weight of debt, multiplied by the weight of equity, and then close parentheses again. So we get a theater beta of 1.33, and then we get a lodging beta equal to, again, we're going to take the pure play here, the asset beta from Marriott. So I'm going to take the asset beta for Marriott multiplied by 1 plus, and then open parentheses again, 1 minus the tax rate, multiplied by the weight of debt divided by the weight of equity, and then close parentheses. And we get a lodging beta of 2.04. So like I mentioned before, they told me and a group of students that was there with me that their lodging side is much more sensitive to market fluctuations, and that's what we see here with both the unlevered beta, or the asset beta, and the equity beta. The lodging side is more sensitive to macroeconomic risks and shifts in the economy. So now we're going to just finish this off by calculating the cost of equity for the theater division and the lodging division. So and for this we're going to use the security market line with the capital asset pricing model. And what that said was that the required rate of return, or the cost of equity, is equal to the risk-free rate, so that's the yield on the 10-year U.S. Treasury, plus the beta, here we go, multiplied by the market risk premium, there we go. And so we get a cost of equity for the theater division of 9.84%. And then the lodging division cost of equity, again using the security market line from the capital asset pricing model, is equal to the risk-free rate plus the beta multiplied by the market risk premium. We get a value here of 13.05%. So this has been a demonstration of using what's referred to as a pure play approach for determining the divisional cost of capital for a firm. Okay. Another approach to determining the division cost of capital is what's called using the accounting beta method. And so for a division for a firm, we don't have a beta. Okay? We can't calculate the beta using the returns for the firm, because we would have to just pull out one division, and we really can't do that. What we can do, though, is we can take the quarterly operating earnings for the firm and regressing that on the operating earnings for the S&P 500 firms to get that value. I've rarely seen this approach used. It's difficult to do. You have to have a lot of information in order to do it. And so most commonly, as long as there is a pure play available, and so with Marcus Corporation, there's certainly some pure plays out there that only operate in those divisions, and so we can use that approach for that. But if there's no pure play available, then using the accounting beta is an approach that you can use. Some other risk adjustments to the weighted average cost of capital. So managers make other adjustments to the discount rate for projects based on different levels of risk. There are two general approaches. One is using a risk-adjusted discount rate, also known as the radar. which uses a different weighted average cost of capital for all of the cash flows of a project. And later on, when we take a look at capital budgeting, you're going to calculate the cash flows for a project. And one way to evaluate a project, if it's riskier than most projects for a firm, is to use a different discount rate, a different cost of equity or weighted average cost of capital for the entire project. Another approach is, rather than looking at all of the cash flows for a project as being riskier than average or less risky than average for a company, is to just look at the individual cash flows within the project. So you might have a project where, let's say at the end of the project, you're going to sell a piece of equipment off. Okay, that cash flow, the cash flow from the sale of the equipment, may be riskier than the cash flows for the first year of the project, because you don't know, it could be several years out. You don't know how marketable that piece of equipment might be, and so you might adjust the discount rate for that single cash flow because it's riskier than the other cash flows for the project. And so that's another approach to adjusting cash flows or projects for the amount of risk associated with them. So a few important considerations. First of these is that all of the sources of capital are provided by investors who require a return. So the sources of capital, again, being common stock, preferred stock, and debt. And when we think about retained earnings for the firm, those earnings that are generated by the firm and then not paid out as dividends, if a company keeps the earnings rather than paying them out, then the firm needs to earn returns on those retained earnings that are adequate to compensate the stockholders for giving up those earnings and not receiving them as dividends. So that's very important. So a couple of things to consider and remember. For a bond, we use the yield to maturity on the bonds. We don't want to use the coupon rate. Okay. So don't use the coupon rate on a bond. For the cost of debt, and don't use the book value of equity to calculate the weight of equity for the firm. And that's it for this set of notes. Please let me know if you have any questions on them.